Take a listen to what Tom Lee just said on CNBC.
Well, it would be a good day for Tom Lee to be here. Joining us now is the aforementioned Tom Lee, managing partner of head of research at Fundstrat Global Advisors, as well as a CNBC contributor. A month ago, when the VIX hit 50 and there were growth fears about the economy, did you ever waver? Did you have any nights where you didn't sleep as well?
There were 3 days of horror, as the market post FOMC all the way to that Tokyo Black Monday. It was gut-wrenching.
Was it? For you?
Yeah, yes. But we viewed this ultimately as being a growth scare, because we didn't think the U.S. was entering recession, which a lot of people thought after that jobs report. And I think people thought there was systematic risk because of what's going on with the yen. But markets showed a lot of resilience since then. I mean, the fact that we snapped back so sharply is showing you how strong this market is.
Still.
Yes.
The revisions yesterday, not on your radar. Should they be on investors' radar screen? I thought it might be a good thing if the job market was not as hot as people thought.
Yes, I think it is incrementally important because the FOMC minutes that came out yesterday as well showed the Fed staff saying this is a strong labor market. Well, that jobs report that came out Friday and the revisions that just came out show a lot of jobs disappeared. It's not as strong a market. And I think it gives more ammunition for the Fed to start a cutting cycle. And that's going to give a lot of life to the economy.
And to the markets.
And to the markets, especially cyclical stocks and small cap stocks.
Tech's already done well. So normally you'd think lower multiples could or at least multiples don't need to stay where they are or contract with the high multiple tech stock. So they could at least feel better about the valuations if rates came down.
Yes, that's right. I think tech is still in a good place because of AI, and NVIDIA should reinforce that. And it's not a demanding multiple. NVIDIA is maybe 28 times forward earnings, which is for one of the most important companies in the world. It's not a high multiple. So if tech is in a good place and then we get Fed cuts, I think it allows the overall market to expand.
Do we see an orderly easing cycle because the Fed doesn't feel like it needs to act intra? They have a meeting where they go 50 or whatever. You think they just 25 and then the next meeting 25, so only do 50 this year and then maybe continue next year? You think it'll be like that?
I think that a soft landing the probabilities are going up, and that's why this should be a benign cutting cycle, like good for markets. But I think the key is the Fed getting off data dependence, because data dependence is the reason they missed the inflation turn. And I think now they're missing the soft landing.
Rearview mirror. But is it possible that they're too restrictive right now and that the lag we don't know how powerful the lag effect of the higher rates could be, and they end up doing 50 or doing a couple of 50s? Is that possible?
I think futures markets are showing more than 2 cuts, so I think the Fed probably is a little behind the curve, and we know there is a recession in housing and durables and auto sales, so there was a lot of pain out there. So cutting more aggressively would actually make sense, at least from the market's perspective.
Where do you think, well, you're a market cap, but where do you think unemployment tops out? Do we get to 5? Do we go over 5% unemployment?
A lot of it has to do with how the Fed communicates to CEOs, because a lot of companies are cautious, right? With monetary policy this tight and real rates this tight, it makes them reluctant to expand. And so the job market itself kind of hinges on what the Fed's doing. And yeah, it could, once the job market starts seeing unemployment rise, it could get bad.
I think Bitcoin's 60,000, give or take. Gold has been hitting new highs, obviously. I think we showed a chart the other day. Kelly was trying to tell me she had been right about
the disconnect.
No, about gold being a bet. So we looked at it over the last 5 years, or I don't know how many years, but gold was up 90% and Bitcoin was up 13,000%.
Okay.
That was that we looked at. So I mean, gold is moving, and it's moving not in a correlated fashion with risk on, whereas Bitcoin definitely looks like it's just a
Does that ever switch?
I think it can. I mean, Bitcoin is just sort of got 2 functions, right? Because it is a risk-on asset, but I think it's an important protection against systematic risk.
Do you ever want it to be correlated to gold?
I think Bitcoin is digital gold, so I think it's replacing gold over time.
So eventually it should act like gold, which means that it shouldn't have the kind of meteoric rise that we're talking about here.
Well, it depends on what the dollar does, because there could be a day that dollar could debase, and then you'd want to own a lot of Bitcoin or gold. But I mean, to me, the fact that gold's rising is showing you there's still a lot of fear out there. I mean, I think gold is almost a measure of the bearish sentiment, and that's why I think stocks still.
Do you have? Can we talk politics for just 1 second? Do you have an election prediction, and as it relates to the market? Do you think the market is do you think anything we're seeing in the markets has anything to do with what's going to happen in November?
Yes, to an extent. I think the markets are believing Trump's probabilities of winning are stronger than the polls are showing. But I think when the market sort of becomes more convinced of that, I think you'll see cyclical stocks do better, small caps, Bitcoin do better, because these are really clear policy differences. But yes, to me, I think over the last couple of days, to me, the market seems like it's betting on Trump's odds being better than the polls.
Okay. All right, Tom, thank you.
Thank you.
I think sometimes you come on later or later in the day. I think it's much better first thing, don't you think?
First thing. Also, he gets it out of his way. He's got the whole day.
Gets it out of his way, but it's just.
And then,
okay,
by the way, his smart comments then get repeated all day on the air.
Right.
Goes on in the
So
afternoon.
if you do go on later, I would say like maybe 7 or 8, but anything over 9, it's just not making sense, right?
It makes sense. I hear you.
And Tom Lee says the fact that the S&P 500 recovered so quickly from Tokyo's Black Monday, this was on August 5th, is a good sign of strength for equity markets. It also says the Fed moving away from data dependence would be incrementally positive for equities. Forward-looking Fed would be getting back quickly to a neutral rate. And Tom Lee also says it has been surprising to see betting markets like Polymarket and Predictit showing a much tighter race than shown by the polls. Tom Lee says if dovish Jackson Hole and FOMC gets off data dependence, rally to new all-time highs becomes greatest probability. Small caps, cyclicals, energy, Bitcoin, and banks will be in favor. And one of the most noteworthy things that Tom Lee was really saying there is that big tech doesn't necessarily need to fall, but it's not going to lead the markets higher in the days, weeks, months to come, and in the future. And I think that's so different from what a lot of people on Wall Street are saying right now, and it really stands out. Now, I am obviously in that camp as well. If you've listened to any of these videos over the past couple of weeks, I do not think big tech offers a great risk to reward at all. I think, in fact, it's quite unfavorable relative to small caps, to cyclicals. I even think buying high quality 4 to 6% yielding dividend stocks, as long as the dividend is not threatened, makes a lot of sense. Okay, why do you think those stocks are paying 5 to 6% dividends, right? Or even 4.5% dividends, something like a CVS Health. Well, it's based on risk, okay? If you can get 5% in a 3-month treasury, a company paying a dividend is going to have to compete with that, okay? And if it's not super attractive, what the dividend yield is on any particular company, then, well, why would you own that over a 10-year treasury? Now, as let's say treasuries, specifically the entirety of the yield curve, the short end is more affected by obviously the Fed cutting or raising rates. That is your very short-term bonds, your 3 to 6 month bonds. Your 10-year treasury is generally what people peg, different assets to, okay? That's what mortgages are pegged to. That's what auto loans are pegged to. That's generally speaking what you would look at like a dividend stock yield to, okay, would be the 10-year treasury. That is sitting at about 3.8%. Why would you not see dividend stocks, quality ones, go up in price and down in yield as the Fed starts to cut rates? As let's say the 10-year treasury goes to 3.5%. Now a 4.5% yielding, safe quality company looks a lot more attractive. right? 5%, 6%, right? They start to look a lot more attractive. I even think dividends value is much more attractive right now than big tech. Also, what was notable from Tom Lee's interview on CNBC today is where he said a soft landing. The probabilities are going up, but I think the key is the Fed getting off of data dependence. He thinks the probabilities are going up of a soft landing, especially as we start to get the Fed reducing rates. Now, with that said, we did have a lot of Fed speakers today and economic data. So let's start with some of the most notable headlines from Fed officials. Fed Collins says today soon it will be appropriate to begin easing policy. I have seen a significant reduction in inflation. She says the economy is still in a pretty good place. I am not seeing red flags. She also says the data gives me more confidence on the path to 2% inflation. And finally, she says the labor market is healthy. I want to preserve it. Fed Harker says, I continue to worry about shelter inflation. He says, I'm not in the camp of 25 basis points or 50 basis point cut. I need more data. But he does say we should start the process of rate cuts and keep it moving. Fed Harker says, my business contacts want a methodical course of rate cuts. The balance of risks are more normal. The Fed must watch jobs more now. He says the latest jobs report was a bit lower than expected, not a lot. Alert coming out from Trading Economics says U.S. stocks fell in afternoon trading as markets continued to gauge the magnitude of Fed rate cuts ahead of Jerome Powell's speech at Jackson Hole tomorrow. Now, we also did get some data this morning. Initial jobless claims came in a little bit higher than expected, 232,000. We were expecting around 230,000. Not a big deal. That's mainly just in line with expectations. A 2,000, give or take number is not what's causing this move today. Continuing jobless claims actually came in lower than expected by about 7,000 or so at 1.863 million. So that was definitely a little bit better than expected. Global composite PMI came in at 54.1. We were expecting 53.5. Global manufacturing PMIs came in at 48.0. We were expecting 49.6. And S&P Global Services PMI came in at 55.2, expecting 54. So the headline number beat estimates, services beat estimates, but manufacturing did miss by almost 2 points. So a little bit more weakness in manufacturing. You had Kansas Fed Composite Index come in at -3. We were expecting -9. So that was worse than expected. And Kansas Fed Manufacturing Index came in at 6. We were expecting -10. So better, much better on the manufacturing side for the Kansas area. But, still not a great overall number for the composite index. So I really think what we are seeing today is simply just some jitters ahead of Jackson Hole. Some people are, placing their bets on what Powell is going to say and do. And some of that is pretty risk off in nature, right? If there's a risk that Powell comes out and is too data dependent, he, perhaps confirms a September cut, but does not signal multiple cuts, that's a problem. Wall Street's pricing in about 100 basis points of easing this year. That is implying a 50 basis point rate cut at least one of the next 3 Fed meetings, right? So do we get a Powell that is that bullish or do we not? I mean, it's hard to say. And honestly, at this point, if the Fed doesn't come out and sound very dovish, that's going to be taken as maybe the Fed's a little too incompetent to engineer a soft landing. Like, the time you want to engineer a soft landing is before a hard landing. And with the data we've gotten recently just being so mixed, some really good or some, I wouldn't say really good, some okay data, some really bad data. Now is the time to engineer that soft landing. And you can see here the US S&P PMI report. Employment fell in August, dropping for the first time in 3 months. Net job losses have now been reported in 3 of the past 5 months, marking the softest spell of payroll growth since the first half of 2020. And that was even data that was out today. So definitely some signs of continuing deterioration in the labor market. And what we have seen after the last couple, Jackson Hole speeches from Powell, they take place in August. Well, in 2022, we did end up, and that really started another test of new lows, another correctionary period. And then back in 2023, it was really around the peak of the markets in 2023. And then you did end up going through a 2.5-month correction or so following that event also. So considering markets are this high and there's a lot of, expectations that are elevated, could we go through another correctionary event after this speech from Powell? It's certainly possible. And I think that is why markets are getting a little jittery today, because there's a lot on the line for tomorrow. With that said, ladies and gentlemen, let me know what you think about this information down below in the comment section. Specifically, do you think the Jackson Hole speech tomorrow from Powell, by the way, it happens at 10 o'clock in the morning, is going to be a negative for markets? Is it going to be a positive for markets? Let me know your thoughts down below in the comments section. Hit the like button as well as subscribe to the channel if you made it to the end of this video to stay more informed about what's going on each and every single day in markets and hopefully help you make more money. You guys enjoy the rest of your day, and I will see you in the next one.